Right now, nearly two-thirds of everyone holding XRP, whether small retail buyers or large institutions, is underwater on their investment. The past week has been brutal for the token, with prices sliding more than 20%, and betting platforms are increasingly pricing in a scenario where XRP drops below $1 before June wraps up, with the probability now sitting at 66%. The question everyone is asking is simple. Have we hit the floor, or is there more pain ahead? Looking at the data, around 40.1 billion XRP tokens are currently held at a loss. To put that in perspective, during the COVID crash, that number was 43.4 billion. During the 2022 bear cycle, it was 42.3 billion. And after the FTX collapse, it reached 45 billion. Yes, the total supply has grown since then, so this is not a record. But the gap between now and those historic lows is narrowing fast. Weekly drawdowns this bad are not unheard of for XRP. The COVID and FTX periods saw drops of 25 to 35%. But losing 20% in 7 days still stings, especially when you were sitting at $2.34 just last week. June has historically been a rough month for XRP. Over the past decade, the token has posted returns of around -7%, -32%, and -34% during this month. With the prediction markets moving so aggressively in just 24 hours, jumping 12 percentage points in a single day toward the sub-dollar outcome, it is hard to ignore the pattern. From a technical standpoint, one analyst points to the monthly RSI as the key thing to watch. Yes, it is falling sharply right now, but that is actually how the biggest macro bottoms in crypto history have formed. The pattern to look for is price making a new low, while RSI quietly starts turning upward, a setup called hidden bullish divergence. That confirmation has not arrived yet. The RSI needs to reclaim the 44 level before anyone can confidently say the trend has shifted. Until then, one more emotional sell-off remains the most likely scenario before any real recovery begins. Another analyst who has been mapping out wave structures for months believes the most probable path involves a flush down toward 92 cents, followed by a short bounce, and then a final test of the 87-cent area, which has been a major support zone in her analysis for a long time. A sustained close back above $1.30 would be the first real sign that sellers have exhausted themselves. The broader debate right now is whether the market delivers a sharp, violent wick downward that shakes out everyone holding nervously, or whether it builds a slow, steady base before moving higher. History from early 2017 suggests the violent wick came first, and then the real rally followed. Many analysts lean toward that outcome again, one last fear-driven move before the next expansion phase. What makes the current setup interesting from a contrarian view is that short sellers have been piling in aggressively, pushing the funding rate to its most negative level in almost a year. When positioning gets this one-sided, the market has a tendency to punish the crowd. A squeeze that catches those shorts off guard could happen quickly and without much warning. On the macro side, capital has been flowing out of the entire crypto market this week. A combination of factors including a small Bitcoin sale by a major institutional holder, an exploit in another blockchain project, and investor appetite shifting toward the anticipated SpaceX public offering all contributed to over $2 trillion leaving equities and crypto alike. Despite all of this, experienced investors who lived through the SEC lawsuit in 2020 are sharing a different perspective. Those who bought during the darkest days of that period and held through months of uncertainty eventually saw gains of over 1,000%. The argument being made is that moments like this one, uncomfortable and uncertain as they are, tend to be the entry points that look obvious only in hindsight. Price targets of $9 to $27 are being discussed for 2028, and a move toward $10 as early as late 2026 or early 2027 is being mapped out by some analysts. Though none of this is guaranteed, and timelines in crypto rarely go exactly to plan.